we had some predictions out of the Fed that really said inflation is going to go down under their projections without without unemployment going too high. Were those realistic?
Uh, they're not really predictions. I think what it is, it's a survey of all the Fed presidents. So it's kind of the numbers that come in. But David, I think what struck me is in order to get inflation down, 50%, which is what they're looking at, to think that we're going to have virtually no change in unemployment or no pain in some other area just seems realistic. And whether or not we can get core inflation down at those levels very much depends on further action by the Fed. So is it possible? Sure, I think it's possible. I think it's unlikely that it will happen without a bigger impact on the broader economy and unemployment.
Let me jump in here. The Fed is trying to operate this solution through two mechanisms. And a lot of people focus just on one of those, the idea being raise interest rates, reduce overall economic activity, which means companies then don't hire as many people. In fact, they fire people, and that slows things down. And that's sort of, that's one way to do it. You reduce the income of households, then they can spend less, and then inflation falls. But the other mechanism is higher interest rates themselves, right, have an impact on financial conditions affecting both households and firms. And households basically say higher interest rates means it's going to cost me more to finance a car, it's going to cost me more to buy furniture, it's going to cost me more to buy a house. Firms are saying it's going to cost them more to do any projects they want to do. But it's the consumer side. If those higher interest rates actually induce consumers, right, to do less of those big purchases, that is the other mechanism, that substitution effect, getting them to wait for a year or 2 years to buy those things when supply might come back. Because it ultimately will hurt the Fed's objective if they reduce overall economic activity too much, because we do need more stuff to be produced also to keep inflation moving in that downward direction.
So, Joanne, that really begs the question of the consumer and the consumer's balance sheet, because there's something like 2.7, I've seen, $1 trillion still sitting in the balance sheet of a lot of households. And maybe they'll just sit on that as savings, or maybe they'll keep spending it, which will make it more difficult for the Fed to get inflation headed down sooner rather than later.
Yeah, that's exactly the other challenge that the Fed faces, is consumers are flush. They've paid off a lot of their debt. They're sitting on a lot of savings. But generally, households, that's a measure of household wealth. And generally, when households spend, they don't ramp up spending because their overall wealth went up. They tend to spread that over time. And in times of uncertainty, they tend to spend less of that. They're going to try to make it last longer. So in this period of time, when people now might start getting worried about what the future holds, whether they're going to keep those jobs that they got, whether new job opportunities might disappear, we may very well get a situation where consumers decide, we better keep those savings in the bank and spend less, and hoping that prices will come down for cars, as they've begun to do, and for other things.
Bob, what about the prices coming down for stocks and for bonds? At what point do you become a buyer of bonds? You've been, obviously, most people have been a seller recently. At what point do they become enough of a bargain it makes sense? And stocks, for that matter, the same thing.
Well, I think in the government bond market, we talked last year that we needed to get interest rates higher. We talked about that. The range of the 10-year has been 1.5% to 3%, virtually for over a decade. It got slightly below that during COVID, but basically when we talked in December and January, it was like at 1.5%. It's now above 3%. So, in some ways you can make an argument that there's real value in the 10-year. My own view, David, is that in order to impact inflation or core inflation at 5%, we're going to have to continue to drive the overnight funds rate closer to 4 to 5%. And what the markets are discounting right now is 3% at the end of this year, maybe 3.5% to 4% at the middle of 2023. I think it's going to get closer to 4 to 5% over time. So I do think the 10-year will go higher. But certainly there's a lot of value in a 10-year, as you show right there, at 3.17% versus what it was just not so long ago at 1.5%.
So, Joanne, what about that on the equity side? If Bob is right, and by the way, he's not alone in saying we got to get to 4 or 5%. If that's right, does that say it's not time to be buying stocks, or are there some shopping opportunities right now?
Yeah, I think it's a good time to be very selective about holding on to various stocks. The Fed clearly has a short-term problem ahead of it. Short-term being, a few years, not 10 years. And if you look at the long-term forecast that the market holds for inflation out to that horizon, it's still only about 2.4%. So inflation expectations are pretty well anchored, and that should help keep the 10-year from going up too much further, but I wouldn't rule out certainly something in the order of 4%. That's going to make it more challenging for growth stocks, there's no question. But companies that have more resilient growth sources, like those providing parts for cloud computing expansion, for data center expansion, these are the types of areas that tend to power through recessions. Companies like a Broadcom or a Cisco are really well positioned for this kind of an environment. And I think investors could find in those, which have come down substantially, real opportunities for solid returns over the longer term.
Bob, you mentioned credit earlier as maybe presenting some opportunities as the spreads really increase. But at what point, if you're really going to 4 or 5, do you have to be worried about defaults? I mean, is credit too risky at this point?
It's spot on. I mean, I think, as you know, David, we started a opportunistic credit fund 2 years ago, and we're already seeing the crack. And I think having dry powder and having an opportunity to invest across the capital structure in good companies who have had maybe a bad financing structure or just don't have access to financing or are being hurt by higher interest rates, there are going to be some fantastic opportunities for investors who can opportunistically look at opportunities for good companies with a poor financing structure. And I think we're already beginning to see those opportunities emerge.
So, Joanne, I'm going to give you last word here. Given what Bob just said, does that argue that you need to be more in cash or cash equivalents right now? Because he said there's going to be opportunities. You need the cash to invest. Are you more in cash than you have been in the past?
No, we're not. We think it's pretty challenging to try to time a market like this. And so being in cash is implicitly a bet against a recovery, at some point in time. It's just very hard to get that right. So our view is investors should be positioned based on their time horizon. If they need cash in the short term, they better not be too exposed to equities. If you're in equities, you really should be looking to the 2-year, 3-year, 4-year, 5-year horizon. And so we don't think it's a good time. In fact, as Bob was saying, we think there are actually opportunities now. Those opportunities may very well get better. We don't know, but there are certainly opportunities now. And a lot of times what investors, our clients, will look for is income from those investments. That helps them ride out these tough times. And you can find a lot of good dividend yielding stocks, some in the growth world where they have those long-term drivers already in place, and some in the safer spaces like in the financials, which will provide some protection against those rising interest rates.